Imagine waking up one morning to find your favorite company's stock is now available to the public. You've been waiting for this moment, but do you know what's happening behind the scenes? Let's break it down. So, you're probably wondering, what's an IPO? Simply put, it's when a private company decides to go public by issuing stocks to the public for the first time. You might have heard of companies like Uber, Airbnb, or Facebook doing this. They all started private, but now you can buy their stocks. But why do companies do this? Well, it's mainly to raise capital for their business. They can use this money to expand, pay off debts, or even fund new projects. Now, let's dive into the process. It's not as simple as just deciding to go public. There are a lot of steps involved. First, the company needs to meet the requirements set by the Securities and Exchange Commission, or SEC. They have to file a registration statement, which includes detailed info about their business, financials, and management team. You'll see this in their prospectus, a document that outlines the company's plans, risks, and opportunities. As you're reading through this, you might be thinking, what about the underwriters? They're like the middlemen between the company and the public. Their job is to help the company determine the initial stock price and manage the IPO process. Now, you're probably wondering, how do they come up with the price? It's based on the company's financials, industry trends, and market conditions. But here's the thing, the price can fluctuate. It's not set in stone. Once the IPO is announced, you'll start seeing a lot of hype around it. You might even see the company's executives on TV, talking about their vision and plans. But don't get too caught up in the excitement just yet. There are risks involved. The stock price could drop, or the company might not perform as well as expected. So, what can you do to prepare? You can start by researching the company, reading their prospectus, and following financial news. It's also important to set a budget and stick to it. Don't invest more than you can afford to lose. Now, let's talk about the different types of IPOs. You've got your traditional IPO, where the company issues new stocks to raise capital. Then there's the direct listing, where the company lists its existing stocks on the exchange without issuing new ones. And finally, you've got the SPAC, or Special Purpose Acquisition Company. It's like a shell company that raises money from investors to acquire another company. Each type has its pros and cons. The traditional IPO is the most common, but it can be expensive and time-consuming. The direct listing is faster and cheaper, but it might not raise as much capital. The SPAC is a bit more complex, but it can be a good option for companies that want to go public quickly. So, which one is right for you? Well, that depends on your investment goals and risk tolerance. You should always do your own research and consider consulting a financial advisor. As you're navigating the world of IPOs, keep in mind that it's not just about making a quick buck. It's about investing in a company's future. You're essentially becoming a part owner of that company. So, take your time, do your research, and stay informed. Subscribe for daily education videos.